All right, let's dive into a real financial head scratcher today. I want you to imagine a huge company. Their profits are just exploding, going through the roof. But their stock price, it's kind of just sitting there. How on earth does that happen? How does a company's success get so completely overlooked by the market? Well, we're going to find out. So let's start with this number right here, 232%. Between early 2023 and late 2025, one company saw its earnings per share, a key measure of profit, absolutely skyrocket by that much. I mean, that's just incredible growth, right? By any standard. But, and this is a big but, during that exact same time, its stock price only went up 88%. Now, don't get me wrong, that's a nice return, but it's not even close to that earnings growth. It's less than half. And that huge gap, well, that's the puzzle we're here to solve today. So this brings us to the big question. How is this even possible? How can what a company actually does in the real world get so disconnected from what the stock market thinks it's worth? Let's dig in. So the company at the center of this whole thing is Newmont Corporation. You might have heard of them. They are the world's largest gold producer, a real heavy hitter in the mining world. And their story over the past few years has created a perfect textbook example of a market mystery. Okay, this one chart basically tells the entire story. See that steep blue line just shooting for the moon? That's Newmont's profits, their earnings per share. It went up, as we said, 232%. Now, look down at that orange line, kind of lagging below it. That's the stock price. And that giant canyon between the two lines? Yep, that's our mystery. Let's put some hard numbers to this. The gap between their earnings and their stock price was a whopping 144 percentage points. But here's the real kicker. The entire gold mining sector, you can track it with an index called GDX, was up 167%. So Newmont, the biggest player in the game, was actually getting beat by its own industry. So what was going on? Was the market just wrong? Or did it see something that the raw profit numbers weren't showing? Turns out there were some very specific reasons for Wall Street's cold feet. Let's start looking for clues. So the market's hesitation really boiled down to three main things. First up, acquisition skepticism. In 2023, Newmont bought another huge company for almost $17 billion, and investors got nervous. They worried about how hard it would be to merge two giants. Second, production worries. The company basically warned everyone that they might mine less gold in the future, and that, spooked people. And finally, there's a sector-wide discount. The whole gold mining industry just tends to trade for cheaper than you'd expect because of all the risks involved. It's a constant headwind. Okay, but this is where the story gets really interesting. All those things we just talked about, the fears about the acquisition, the worries about production, they created this powerful side effect. They opened up these incredible windows of opportunity for anyone who was willing to look past the scary headlines. Just look at this timeline. It maps out those moments perfectly. Every single dip was tied to some specific bad news. But look at February 2024. That's the big one. Right when the fear about that big merger was at its absolute peak, the stock hit rock bottom, offering a mind-blowing 240% potential return from that point. It's a crystal clear pattern. The moment of maximum fear created the moment of maximum opportunity. The analysis we're pulling from has a great name for this. They call it a generational entry point. It's that super rare moment when fear about one specific company crashes right into the lowest point of the whole industry cycle. It's when maximum pessimism, everyone thinking the worst, actually creates the foundation for maximum upside. And this quote from the analysis just nails it. It says, the market priced in worst-case integration scenarios while gold fundamentals strengthened. This was the single best entry point of the entire period. So basically, everyone was freaking out about the story of the acquisition while the actual market for gold itself was quietly getting stronger. That massive disconnect between the narrative and the reality, that's what created that perfect moment. So, that's great in hindsight. But how could you actually spot these disconnects as they're happening? Well, the analysis lays out a kind of detective's toolkit, if you will, a simple, rules-based framework for trying to identify these rare moments. And here's how that playbook works. It scores opportunities using 4 key pillars. First, valuation. Basically, is the stock cheap compared to its profits? Second, gold momentum. Is the price of gold itself trending up? Third, relative strength. Is this stock doing better than its rivals? And finally, technicals. Do the chart patterns look good? You can see clear as day, back in February 2024,
It was buy, 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 buy across the board, a nearly perfect score of 95. Fast forward to October 2025, and the picture's a lot more mixed, leading to a much more cautious score of 55.
When you boil it all down, the whole story comes back to this one powerful idea. The historical data for Newmont shows, without a doubt, a clear and repeating pattern. The moments of widespread fear have consistently created the absolute best opportunities.
And this leaves us with a final, really fascinating question to think about. In the world of investing, what's really more powerful? What holds more sway over a stock's price? Is it the cold, hard data, the fundamental numbers on a spreadsheet? Or is it the emotional, compelling, and sometimes downright scary story that people tell themselves? The case of Newmont certainly suggests the answer is a lot more complicated than you might think.